I work with Paraswap and Liquidity, and today we're going to go on the 20-minute journey where we revisit 4 years of on-chain DEXes history. So it's going to be quite a ride. Buckle up. So this is roughly the plan. Before we dive in, I want to put some context back on the SEX versus what we call, the DEXes versus what we call centralized exchange SEXes, usually operating under a central logic order book, or CLOB. Sorry for the term, but we'll have to go through them. But essentially the core of the presentation is more to tell you about the two legs of what makes a decentralized exchange. So on one hand, the liquidity structures and how they evolved over the last 4 years, and on the other, the different model for incentivizing liquidity providers. So how we split the cake, essentially. And then we can go through example with like DEXes we've seen. So for the intro, quick pointers on essentially Coinbase versus Uniswap, but this is DEX versus SEXes. Before we go into the specific of liquidity structure and so on, let's not forget the basics. For a centralized exchange like Coinbase or Binance, you need to KYC with them. You need to provide proof of funds potentially. You need to verify your identity and have an address. On Uniswap, you just need to have a wallet. It also has different requirements. At the end of the day, a centralized exchange can suspend service at any time. And we've seen that happen quite a few times. Just recently, Binance pausing some withdrawal of assets for a few hours. Versus Uniswap cannot be halted in any way. There is no way of Uniswap telling you, sorry, I can't swap your ETH to USDC. That's kind of the baseline. Now, for the other thing that we're not too used to in DeFi is this order book logic. Because with pools on Uniswap, the pricing model is completely different. Here, actually, the metaphor would be essentially NFT markets, where they work with a bid and an ask, just like a centralized logic order book. So, essentially, you have buyers, you have sellers, and the current market price is essentially here. And you always have a spread between, what the top seller is asking and what the top buyer is offering. So just for more context on this is usually seen as the most efficient way to structure liquidity, but it comes with a problem, which is during the name. You usually need a centralized entity to maintain the order book, simply because it's a high throughput operation. So in terms of market share, it looks like this. The green one is Coinbase, the blue one is Uniswap. So you can see that since the first 2 quarters of the year, so last 2 bars are Q1 and Q2 2023, you have actually Uniswap over Coinbase in volume of trade processed. So it's evolving in the right direction, but the full picture is actually this one. So this one is with Binance, and Binance is the blue line. And as you can see, once you add in Binance, it doesn't really matter the difference between Uniswap and Coinbase anymore in terms of volume. We don't really see them at the bottom of the chart. So the full story being, the volume on DEX is increasing, but at the end of the day, we still have a vast majority of volume being routed through centralized exchange, Binance and others. Now, for kind of the why of that, so this is a bit of a comparison between a DEX and a centralized logic order book. And I date this as 2018, because this is literally comparing against Uniswap V1, essentially. And what I want to show you with this talk is that the more modern take is actually this one. So as you can see, quite a few topics evolved over the last 5 years, especially when it comes to like functionalities, for instance. So doing a limit order wasn't really possible on chain a few years ago. We have tons of tools to do it through various ways, be it Uniswap V3, CoSwap, an aggregator, and so on. Other arguments are like the type of tokens you can support on those services. Used to be kind of the SEX was seen as better for what we call the blue chips, ETH, Bitcoin against stablecoin pairs essentially, and DEXes were offering the chance for those long tail assets that don't have much desire from centralized exchange to be listed to have liquidity. But it turns out now we have solutions fitting all types of assets, even on the DEX. And to make this even more blurry, we now have projects that are essentially building on-chain order books. So a decentralized order book, if you may. So this is one of them, Mangrove. There are a few others looking at the topic, but essentially there are ways we can envision to bring that order book on-chain, which would enable kind of a best of both worlds type of situation. but this is more pioneering tech. Essentially, it's not out yet. It should be out in the next few months, if all goes well for them. So let's talk liquidity structure. This is roughly the timeline of evolutions we've seen over 4 years. So it starts with a very basic one, the Uniswap V1, V2 style, where essentially you have two assets paired with one another in a pool weighted 50-50. And what it means in terms of price distribution is you're assuming a price that goes from 0 to plus infinity in relative price of the both assets. So it has some benefit. For instance, the liquidity is available at all prices, but it has drawbacks because obviously it's not the most efficient way of distributing liquidity. Now you have other formula, like a stable swap for the curve that came a bit later, and those are making some assumptions, we'll see later, but they allow much better pricing over a certain area of the pricing curve. So as you would have guessed, the peg area. Balancer is pretty much quality of life enhancement, let's say, over the Uniswap structure. So we can kind of skip it. Where it becomes more interesting is Uniswap V3, because that's the beginning of concentrated liquidity, and that marks another big leap in how we shape liquidity on chain. Finally, we have a little favorite of mine, Maverick, which is the step further after Uniswap V3, in my perspective, both in terms of customization, how much you can express your liquidity, and also automation layer on top of it. And yeah, it's interesting because it's a bit like the response to your talk, essentially, in the sense that it's the same pattern here on DEXes, where you have increased complexity at the base level, but that enables to handle situations more gracefully. So this is just to show you the pricing curve a bit. So you have the Uniswap in purple, stable swap in blue, and this red dot line is just a 1-1 price curve to show you. Damn, taking microphone. Okay. So what you can see is Uniswap is very broad. You can see that the stable swap is pretty much overlapping the red line, especially in that area of 5.5 here. And this is literally making the assumption that when both assets are priced relatively close to 1-1 at one another, this is where you have the maximum amount of liquidity. But obviously, as soon as you move from that price range, you enter into some problems. You might have seen it, for instance, DPEG stablecoins or ETHLSDs that have some premium or discount against raw ETH. So this is Uniswap V3. So here it's a bit differently. Here you have a Uniswap V2 style liquidity, so 0 to infinity, as I was saying. While Uniswap V3 allows you to focus on certain range of that price. So if we're talking ETH stablecoin, for instance, here you're literally providing liquidity from ETH equals 0 to ETH equals trillions of dollars, the same amount of liquidity concentrated on everything. Let's just here you can focus your liquidity. So I don't know, with an ETH at 1900 currently, maybe you will want to be providing liquidity from, I don't know, 1700 to 2000 to have a bit of margin. This is Maverick. So Maverick, you go a bit farther. So one of the main things is what I call this custom density. So on Uniswap V3, you pick a range, your 1800 to 2000, for instance, and your liquidity is distributed evenly within that range. With Maverick, you can literally draw your ranges as you want, and it has some benefits I'll show you later. For instance, it allows you to do some walls, being buying walls or selling walls, that are really useful on stable coins to help them stay at peg, or on wrapped assets to help them keep the peg with the underlying assets. The drawback is similar to Uniswap V3 concentrated liquidity, in the sense that it's potentially more work for the LP, more risk of impermanent loss, the more you are concentrated. Now, the funny thing with MAV is they have several modes. So the previous mode I presented you is static. Now it has a system to essentially help your concentration following the price. So it's a bit tricky to understand, but as you can see in this chart, essentially it's not rebalancing asset. So you see here you start with half of each asset, then the price push the asset full orange, and then essentially your liquidity just follow. And then what happens with your asset balance depends on the price evolution. But the interest of this is essentially that when you have concentrated liquidity, the biggest problem is the more you concentrate, the more you are efficient at processing trades, but then the smaller the movement you need to be completely out of range and providing zero liquidity because you're out of range. So this allows to have a very highly concentrated liquidity distribution that follows the price one way or another. So it's like more tool, more complexity, but it refines the strategies that it can do. So that's for the liquidity structure, but that's only half of the story. Now we need to look at the incentive model. And here I have a bit of a timeline. I'm going to be a bit quicker. So Uniswap V1, very straightforward. V2, it's the same. 0.30% fee on each swap, 100% of which is given to the liquidity providers of the pool, auto-compounded directly in the LP token. Straightforward. The second big iteration on this was the curve CRV tokenomics. We'll go into this a bit deeper, but here the core concept is the DEX takes some of the fees from the LP, and in exchange give them the token and try to make them enter in a whole loop with the token locking and so on. So this is pretty much what happened in 2021, the whole ecosystem around Curve. We'll see that in a few slides. And then was Uniswap V3 with the concentrated liquidity. So we're still on a model where all the fees are given to LPs, but because here you have various pool structure you can do, you have various tiers of fee per pool, it's a bit different. They have a bit more options essentially in how they want to charge fees. Then you have other models, I'll probably kind of speed run through them, but just to mention them, that are trying to iterate on the VCRV model and improve further. So those are Velodrome shipped last year and Retro shipped this year. Those are examples. We can discuss some of them. So this one is a bit of the bulky one to figure out. So that's the godfather, as I call it, the VCRV tokenomics. So I don't know how familiar you are with DeFi, so I'm going to give you a 1 minute speed run just in case. The base principle is that, as I was saying, 50% of the fees collected on Curve when people are making exchanges are essentially captured at the DAO level. And now there is a whole game regarding the obtention of those fees. So the way it works is you have your CRV token. To get involved with the Curve DAOs, you need to lock them for up to 4 years. And that's how you obtain this VECRV. And then once you have the VECRV, you have access to all that I listed on the right. So governance power over Curve governance, and the Gauge voting power. You have the LP boost, we might dive into this, but essentially bonus on your earning if you're yourself an LP on Curve. With the Gauge votes comes some potential bribes. So either you want yourself to direct, we'll get into the Gauge first. So the Gauge are, every week there is CRV emissions at the DEX level, and the Gauge are here to determine where those emissions are going in terms of pool. So for instance, Frax would want to support that coin. So what they do is they use the CRV token to allocate the CRV emissions towards Frax USDC pool, for instance. It enables them to attract more liquidity on that pair and grow it. And then the last thing and big deal too is the admin fees, as they call them. So the fees taken on LPs are redistributed as stablecoin to the CRV holders. Now there is a bit of a downside here, which is the fees are mutualized. So it means whatever the pool you are voting on, you get the same fees. It's just based on the amount of VCRV you own. We'll see why it's maybe not the best design you made. But so this is Curve ecosystem in 2021 roughly. At first it was pretty straightforward, but you already have 3 or 4 services building on top. This is in 2022, and I'm still keeping track. I didn't do it for this year, but you kind of see the pattern here. It's like this tokenomics is essentially calling for layers and layers and layers of construction on top. Now you have at least 3 additional layers on top of what is shown here. The latest flavor of the month layer just launched recently, Prisma, if you want to check it out. But yeah, so that's, is it a limitation or not? I don't know, but it makes it harder for projects to navigate this. So there are other protocols looking at this tokenomics and trying to think on how they can get inspired from it, but build better. One of them is Velodrome, and they make just a few changes, but a really interesting one. So one of the first things is they got rid of that LP boost, meaning it doesn't matter how many Velo you have locked, you're earning the same yield. And it's a way of kind of protecting themselves against the meta protocol like Convex. Now, I guess the biggest change here is instead of taking half of the fees of LPs, they take the whole thing. So LPs get none of the fees, and then pay entirely with the Velo token. And now this allows for a better alignment at the voter level, because the voter on a given gauge, on a given pool every week, they get the fees this pool generates. And so there is a feedback loop here, so that if you vote for a pool that is not producing so much volume, you won't collect that much fees. So it's the idea of, that the voters will progressively direct the votes towards the pools that are the most relevant for the DEX, allowing it to process the most volume. But it's not exactly like that it works, obviously, because you still have bribes, and bribes can skew this whole equation. But it's an improvement in aligning the votes and making sure your owners, your token owners, are trying to do what's best for the DEX, essentially. You have another step on this Velo model. We can go quickly, so I have time to walk you through the model. But here, essentially, there are like two main changes. The first one is it's using concentrated liquidity from Uniswap v3, and they have a tool to distribute those incentives through a gauge model to concentrated liquidity. That's Merkel, we'll see in a minute. Now, on top of that, instead of just giving you their token directly, the naked retro token, they distribute the rewards in an option token, or retro. And now there is a whole additional layer of game of, depending on what you want to do with your all retro, when you exercise it, you get more or less favorable terms. So if you just want to lock it for the max location, duration, you get an instant 1-1 exchange. You can exchange one all retro for one VE retro locked for 2 years. But if you want to redeem it liquid, it acts like a call buy option, essentially. So you have to provide some external capital to buy a retro and then be able to dump them or use them as liquidity or whatsoever. So that's a way of creating a flow on the token and is trying to align LPs over time. It has merits, but yeah, it's also more complex. So this one is probably one of the most interesting things that came out in terms of incentivization tools that we have. This is from Anger Protocol that does a stablecoin, and they kind of built this for themselves and then opened it up. It's essentially a way of distributing rewards to Uniswap v3 liquidity providers, but with a high level of customization at the project level. So you can choose to just incentivize, like this see on screen, a very evenly distributed liquidity. You pay the same side, the same amount, or you can go into more directional liquidity, which I will walk you through in a minute. So I'm just going to do a few of these so we can talk about the end, the most interesting one. But this is just to give you a recap on how everything kind of plugged together. So this is at Uniswap level, essentially what it looks like if you merge incentive model and liquidity structure together. So for Uniswap, it's pretty straightforward. You have literally the top DEX processing about half of the volume, live on 10 chains, and also arguably the most resilient DEX in terms of how it's built and in terms of market record, essentially, because they didn't suffer any critical issues since their launch, even on previous version. So it's really like the minimal infrastructure, giving back 100% to the LP currently, and the most pattern tested. So it has a lot of merits. And yet, just to finish on this, it's also feeding all types of tokens, be them volatile, stable coins, derivative. There is no strong specialization on Uniswap. It works with them all. With something like Curve, you can see the maths are a bit different here. So it's more geared for projects, essentially, because this whole incentivization model helps projects sustain the liquidity over time, but it doesn't make it the most accessible for just a retail user. In terms of metrics, it's about 10% of the total volume of DEXes for roughly half of the TVL of Uniswap, to give you some reference. In terms of tokens, you all know it's mostly for stable coins and what I call derivatives, so those Civic, CRV, for instance, or the ETH staking derivatives and so on. The new kid on the block, Maverick. So this one was launched this year, and it's already kind of trailing Curve in volume, / overtaking Curve over some days, with about 140, 150 of the Curve TVL. So you can really see the increased efficiency here. The liquidity is much more utilized on Maverick than it is on Curve. And for the benefits, I think I'll kind of walk you through them, and I will show you in a few slides. But it's really this idea of, it's a new tool with allowing much more expressivity for the LP, and so it opens up more strategies, be it for a liquidity provider, but also for a project looking to structure the liquidity. In terms of token distribution, I think at the end of the day would be like Uniswap v3, pretty much fitted for every token. But like every shiny new tool, we are learning progressively. And so far, it seems people are learning faster on stable coin and derivative. They haven't figured out the best structures for volatile token yet. So without drum roll to get the rundown, let's talk about the interesting stuff. So as you may have known or not, this is a bit like practical case to wrap up the talk. And yeah, it's funny because it talks about governance too. So the Avi DAO has a stablecoin called Go, and this stablecoin has been launched mid-July and has been having some big issue pretty much since the launch. So there were several decisions taken by governance to try to address this problem. Some of them are at the product level, they're raising interest rate on Go, they're trying to provide more utility to Go and so on. But one of them was more at the liquidity level. So the governance selected a committee made of 7 people, myself included, and gave it a budget of 400,000 Do over 3 months to try to do some liquidity-related effort that would help improve the pay. What happened with that committee is pretty much a story of governance. Everybody started to run their own way with good ideas, but it wasn't really like a central coordination and vision. So 2 weeks in, I kind of ring the alarm bell and suggested that I would take the leadership of that committee to try to have an action that would go in the right direction. So it's been, it was last week actually. So we're just starting under this revised leadership. And I have a 1 month objective to bring it at a 0.985. So right now it's about 2 cents below that mark. So the way we're doing that, now that you have the context, and that's the most interesting thing, that's what we call directional liquidity. And it's essentially the core idea is, think about Uniswap V2, so those 50-50 pool. If you put some incentive on such a pool, you cannot express anything. You must pay both sides the same way, because each token is made 50% of one token, 50% of the other token. So if you put incentives on the ownership of the LP token, it's like saying, I give as much incentive to my buyer and to my seller, because you can't choose. The pool is made like that. But now with something like Maverick, or even with Uniswap V3 through another layer, you can actually discriminate between your buying liquidity and your selling liquidity, and essentially decide to pay more the buying side or the selling side. This is really what we're doing here through 2 different means. So on Maverick, the project directly can shape the liquidity, meaning drawing this liquidity. So you see here, this is current price. Here it's the USDC component of the liquidity, and here it's the Go selling component of the liquidity. And essentially what this structure creates is a buy wall, as you can see here. You have large ticks of USDC reserve to buy to essentially sustain this price of or above. The pool was launched in this area, and you see it a bit after launch when it already pushed the price 20. So that's one way to do it on Maverick, where you create that structure unbalanced with buying more or selling more, and then you're providing incentive for people who accept to essentially join that boosted pool, meaning provide the liquidity in the exact way you drew. On Angle, it's a bit more subtle, the way it works with Merkle. So with Merkle, the cool thing is your liquidity ends up on Uniswap V3. So you're paying for incentivization of a Uniswap V3 LP. But what you can do here that's quite unique is you can customize your distribution formula to essentially factor different elements with a different weight. So you have 3 elements that goes in the formula: the proportion of token A, the proportion of token B, and then the amount of fees collected. And you can kind of fine-tune all those parameters. So to create a buying liquidity on Go, I'll show you the campaign here. We started with the first campaign, where essentially the reward computations are based 15% on Go supplied to the pool, 80% on the USDC supplied to the pool, and 5% on the fees collected on the pool. So what it means is to get the most out of those rewards, you need to do an LP supply that will process volume, but is roughly 5 times overweighted in USDC compared to Go, so you're providing a large amount of buying liquidity to the pair. And that's how you maximize your rewards. But yeah, key difference is here you're really forcing people to take that structure. Versus here you're just skewing the distribution of reward toward the people that match it best. So that's like kind of the pioneering stuff on liquidity right now. Worth a follow if you're interested in stablecoin. And I just wanted to wrap up with another thing that is kind of flying under the radar, but should impact us heavily next year, which is Uniswap X. So it's not the next version of Uniswap, that's an independent development. done by the Uniswap team. And it will potentially change quite a few things as to how swaps are done and the whole vision people have interacting with an app. So you might have heard about intent already. I'll go back to them in a minute, but it's really a different way of structuring transaction. But I guess the most interesting things to begin with is this coincidence of want that you maybe already know if you use, for instance, CoSwap. It's essentially this idea that whatever you want to do on chain, be it lending like Morpho or being a swap, the most efficient path will always be finding a peer that want to do the opposite of you. So if you're looking to sell 5 ETH for USDC, I don't need to analyze any solution to tell you that the best solution is finding exactly a guy who wants the opposite trade, so who has USDC and wants to buy ETH. Because you will just agree at the market price, but you both avoid the gas cost and the fees of the liquidity pool. So you're both, it's like cutting a deal with your Airbnb host so that you pay him in cash. You know, it's a win-win situation. So that's a coincidence of want. Then there is this idea of aggregation. So when the coincidence of wants cannot happen, when they don't find the opposite of your trade, then it reverts to an aggregation like what you can have on one chain. And finally, the exchange that goes with the intent, it's now on top of just doing on the same chain swaps, you can also express in your intent a chain. So your swap, instead of being, I have 5 ETH and I want to sell them for USDC, it can be I have 5 ETH on Ethereum and I want USDC on Arbitrum. And now in that formula, everything will be computed so that, you know, look at the different route to bridge that ETH to Arbitrum. Is it better to bridge it on Arbitrum and then sell it here, or do the same on mainnet and then bridge to USDC and so on? The core concept here, and it's on this one, the last one, is this notion of filler. Because essentially what you're doing is you no longer, so when you're doing a swap on a Paraswap right now, for instance, Paraswap will compute for you what is the best route, and then the transaction that you sign on chain is kind of hard coding those routes, if I may. So if Paraswap computed for you that the best route is to go 1/3 through Uniswap and 2/3 through Curve, what you're sending on chain is, hey, I want to swap my 10 ETH, and 1/3 will go through Uniswap and 2/3 through Curve. Versus here, what you sign on chain is essentially an intent. So hey, I want to sell my ETH for USDC at the best price, and then those fillers compete to provide the best resolution of your class, essentially. So it's a way of structuring it so it starts to be a bit more efficient. It has centralization risk too, so it's not a free lunch. But I think it's a really interesting avenue for growth. And it will change the landscape quite a bit, potentially even more at the aggregator level than at the DEX level itself. So yeah, that's it for me. And thanks for your attention.
Thank you very much. Now, last but not least, Kenny